The biggest silver trade of this decade may already be behind us, and the most dangerous part of it may be just ahead. I'm not saying that to be dramatic. I'm saying it because the behavior underneath the headlines has changed, quietly, deliberately, and almost nobody seems to be watching the right signals anymore. Silver just delivered one of the strongest runs most investors will ever see. Triple-digit gains, life-changing moves, the kind of performance that convinces people they finally found the obvious trade. And when a trade starts to feel obvious, that's when it stops being safe. Here's the uncomfortable truth. The crowd is still celebrating what just happened. Wall Street is already preparing for what comes next. And those two timelines rarely overlap. Silver didn't just go up, it rewired expectations. It trained investors to believe that momentum itself is the strategy. That if something worked this well last year, it must keep working next year. That the hardest part is already done. But markets don't reward comfort. They reward anticipation. And right now, anticipation is happening in places most retail traders never look. Pause for a moment and think about this. If silver's path forward were as straightforward as the headlines suggest, would the largest institutions on the planet really be this quiet? Would positioning be this subtle? Would the smartest money be this patient? Because that's what's happening right now. Not panic, not euphoria, preparation. Over the next few minutes, I am going to walk you through why 2026 is in T shaping up as a continuation, but as a setup. A setup built on shifting incentives, changing supply behavior, and a growing gap between what retail believes and what institutions are actually doing. This isn't about calling a top or predicting a crash. It's about recognizing when the game itself starts to change. And the first sign of that change isn't price, it's positioning. Most people assume Wall Street reacts to markets. In reality, it moves first and lets price do the talking later. By the time consensus forms, the real work is already done. That's why the most important moves are often invisible when they re-happening, and obvious only in hindsight. But what happens next may surprise you. Because while retail attention is clustering around a single narrative, institutional behavior is starting to drift in a different direction entirely, quietly, gradually, without headlines. And that divergence is the reason you need to understand this moment clearly, before it becomes obvious to everyone else. This isn't about fear, it's about timing. And if you want to understand where silver is really headed in 2026, the first thing you need to understand is what the crowd believes right now, and why that belief itself may be the warning. To understand why this setup is forming, you first need to understand what the crowd believes right now, not what headlines imply, not what social media amplifies, what people are actually betting on. Because markets don't turn when fear is high. They turn when confidence becomes universal. After silver's explosive run, retail sentiment has reached a level that feels reassuring on the surface and dangerous underneath. Surveys, positioning data, and flow reports all point to the same conclusion. A majority of retail investors expect silver to repeat its performance, not just rise, lead again, dominate again, become the obvious winner for another year. And that belief makes sense emotionally. People didn't just watch silver go up. They watched it reward conviction. They watched pullbacks get bought. They watched skeptics get silenced. Success trains expectation. Expectation hardens into certainty. But here's the problem. Markets don't care what feels earned. When more than half of participants independently arrive at the same conclusion, something subtle happens. The trade stops being a discovery process and starts becoming a consensus position. And consensus is fragile. It doesn't take bad news to break it. It only takes different news. Think about how rare this level of agreement actually is. Retail investors are usually divided. Opinions are scattered. But right now, silver has become the focal point. The story everyone knows, the trade everyone understands. The one people feel late to, but still safe chasing. That's not bullish, that's crowded. And here's where the contrast begins to matter. While silver commands the lion's share of attention, capital, and conversation, other metals, some with nearly identical performance profiles, are barely being discussed at all. Same environment, similar gains, completely different expectations. That imbalance isn't accidental, it's psychological. Retail attention doesn't flow evenly. It piles into narratives that feel proven. And once enough people pile in, the trade stops needing new buyers to go higher. It starts needing perfection to avoid disappointment. Any deviation from the expected path becomes a risk. This is where most investors make a critical mistake. They confuse popularity with probability. They assume that because a trade is widely believed, it must also be well supported. But belief doesn't create liquidity. Positioning does. And when too many people are already positioned the same way, the market's ability to absorb surprises weakens. Here's the quiet danger. When everyone expects continuation, even neutral outcomes feel negative. Sideways price action feels like failure. Consolidation feels like betrayal. And that emotional pressure creates the conditions for exits, not entries. But this is only half the picture. Because while retail conviction is rising, something else is happening beneath the surface, something far less visible. Institutional desks aren't debating whether silver was a good trade. They're asking a different question entirely. What changes after a trade becomes this crowded? That's where the real story begins. This is the point where most retail narratives and institutional thinking begin to separate. Not loudly, not all at once, but subtly, through language, through positioning, through what stops being emphasized. Because while retail investors are asking whether silver can repeat last year's performance, institutional desks are asking a very different question. They're asking whether the conditions that made that performance possible still exist, and that distinction matters more than most people realize. On the surface, nothing looks broken. Price is elevated, the story still sounds strong, demand headlines still circulate. But underneath that surface, the framing has started to shift. Not from bullish to bearish overnight, but from expansion to normalization, from scarcity to response. This is where institutional research becomes revealing. Instead of talking about upside targets and momentum, the language begins to focus on mechanics, inventory, flow, elasticity. Words that rarely show up in viral headlines, but almost always show up before major transitions. Here's the key insight. The rally that pushed silver higher wasn't just driven by enthusiasm. It was driven by a specific imbalance, a period where physical availability tightened faster than the market expected, creating stress in places that aren't visible on a price chart. That stress mattered. It created urgency. It pulled buyers forward. It rewarded anyone positioned early. But stress doesn't last forever. What institutions are now tracking is not price strength, but response. How supply behaves after prices reach levels that change incentives. How participants who were previously inactive suddenly become willing sellers. How flows that once drained begin to reverse. And this is where retail often falls behind. Because by the time price confirms a shift, the positioning is already adjusted. Let me put it simply. Institutions don't wait for confirmation. They wait for conditions. When conditions change, they move, even if the chart hasn't caught up yet. That's not prediction. That's risk management. Here's a question worth sitting with. If the forces that tighten the market are no longer intensifying, what happens to a trade that depends on continued tightness to justify its valuation? That doesn't mean silver collapses. It doesn't mean the long-term case disappears. But it does mean the nature of the trade changes. Momentum gives way to digestion. Certainty gives way to range, and crowded positions become vulnerable to frustration rather than fear. This is the phase Wall Street prepares for quietly. Because transitions don't announce themselves, they reveal themselves slowly, through research notes that change tone, through positioning that becomes less aggressive, through capital that stops chasing and starts waiting. And once that shift begins, the market no longer needs bad news to move lower. It only needs the absence of new reasons to move higher. That's the setup forming now. But to really understand why this matters, you have to look beyond sentiment and research and into the mechanics that actually determine whether a market stays tight or starts to loosen. That's where the real pressure point is forming. This is the part of the story most silver bulls don't like to talk about, not because it's complicated, but because it's inconvenient. Markets don't just respond to demand, they respond to incentives. And when prices rise far enough, they begin to change behavior in ways that aren't visible until it's already happening. Silver's rally didn't just attract buyers, it sent a signal. That signal reached places the crowd never tracks. Scrap dealers who had been sitting on inventory, private holders who were content to wait, industrial participants who suddenly saw an opportunity to hedge future needs at favorable levels. When prices were low, none of those participants mattered. When prices surged, all of them woke up at once. This is how supply responses actually work. They don't arrive gradually. They arrive when price crosses a threshold that makes action rational. And once that threshold is crossed, the flow can reverse faster than most investors expect. Here's where the misconception creeps in. Many investors assume supply is static, that what's available today will be roughly the same tomorrow. But in reality, supply is elastic, especially in markets where a large portion of material is held off market, locked away, waiting for the right incentive. Silver has a lot of that hidden supply. And when prices climbed high enough, that supply didn't trickle back. It moved decisively. Inventories that had been tightening began to refill. Stress that had been building quietly started to ease. The conditions that justified urgency began to soften. This isn't manipulation. It's economics. High prices don't just encourage production. They unlock behavior. They bring metal out of vaults. They turn long-term holders into sellers. They convert scarcity narratives into replenishment cycles. And once that cycle starts, it doesn't need demand to disappear to change the market's tone. It only needs demand to stop accelerating. Here's the uncomfortable part. Most retail investors never see this shift while it's happening. They see it later, after price stops responding the way it used to, after rallies stall, after dips stop bouncing cleanly, after the market begins to feel different, even though nothing obvious has changed. That feeling is the signal. It's the moment when a trade stops being about shortage and starts being about balance. And balance is where momentum trades go to slow down. This is why institutions focus less on headlines and more on flows, not what people are saying, but what metal is actually doing, where it's moving, how quickly inventories rebuild, whether tightness is intensifying or dissipating. Because once supply begins to respond, the burden of proof flips. Prices no longer rise because of what might happen. They rise only if demand can overwhelm a market that's no longer constrained. And that's a much harder test to pass. This is why Wall Street doesn't wait for price to confirm the shift. By the time price reflects it, the opportunity has already changed. The risk reward is no longer asymmetric. It's conditional. And that's when positioning starts to change, quietly, carefully, and ahead of consensus. This is where the behavior of institutions starts to look confusing, unless you understand how they think. Wall Street doesn't wait for certainty. It waits for imbalance. And once that imbalance begins to correct, the job is no longer to maximize upside. It's to protect positioning before the rest of the market realizes the environment has shifted. That's why institutional desks rarely exit trades all at once. They scale, they rotate, they reduce exposure quietly while the narrative still feels intact. By the time headlines change, the adjustment has already happened. This is the mistake retail investors make again and again. They assume the smart money reacts to news. In reality, the smart money reacts to structure, to whether the conditions that once made a trade asymmetric still exist. And in silver's case, that asymmetry has started to fade. When a trade becomes crowded, institutions don't argue with the crowd. They let the crowd be right until it isn't. They stop adding risk. They stop defending levels aggressively. They begin looking elsewhere for better setups with less consensus and more margin for error. That's what moving early actually means. It doesn't mean dumping positions or calling for collapse. It means recognizing that the easiest part of the trade is over, that future gains require increasingly favorable conditions. That downside, risks no longer come with equal upside compensation. Here's the subtle shift most people miss. Institutions aren't bearish on silver's existence. They're cautious about silver's role, whether it remains the best vehicle for expressing a broader metals thesis, whether the risk-reward still justifies concentration. And when the answer starts to become unclear, capital doesn't sit still. It looks for relative opportunity. This is where things get uncomfortable for retail participants. Because relative opportunity often exists in places that feel boring, ignored, or premature, places without viral narratives, places without obvious momentum. That discomfort is the tell. If silver were still the cleanest expression of the macro backdrop, institutions wouldn't be hedging their enthusiasm. They wouldn't be talking about balance instead of shortage. They wouldn't be emphasizing patience over participation. But that's exactly what's happening now. And while retail attention remains fixed on what silver just did, institutional capital is already asking a different question. Not how high can this go, but what offers better asymmetry from here? That question doesn't get answered in headlines, it gets answered in allocation decisions. And once those decisions begin to shift, the market doesn't need a trigger, it only needs time. Because when capital starts to drift quietly, price eventually follows. This is where the picture becomes clearer and more uncomfortable. When capital starts looking for asymmetry, it doesn't chase what's already been proven. It looks for what's been overlooked. Not because it's exciting, but because it's mispriced relative to attention, risk, and positioning. Right now, that imbalance is impossible to ignore. Silver commands the spotlight. It dominates conversation, allocation, and expectation. It's the metal most investors feel they understand. And that familiarity creates a false sense of safety. Because familiarity lowers skepticism. It makes people assume that risk has already been priced in. But look at what's happening just outside that spotlight. Other metals operating in the same macro environment, subject to many of the same forces, are attracting a fraction of the attention. Fewer headlines, less retail participation, smaller emotional commitment. And that lack of attention matters more than most people realize. Markets don't move on stories alone. They move on imbalances between belief and capital. When an asset is widely owned and widely expected to perform, it becomes fragile. Any outcome short of perfection feels disappointing. But when an asset is lightly owned and barely discussed, expectations are low. And low expectations create room for surprise. This is why institutions are drawn to obscurity, not because it guarantees upside, but because it limits downside. When fewer people are crowded into the same trade, exits are calmer, volatility is more manageable, and the risk of sudden emotional selling is lower. Here's the psychological challenge. Moving away from yesterday's winner feels like giving something up. It feels like admitting the story might be changing. And that's uncomfortable, especially after a year of validation. But institutions aren't emotional about past performance. They're forward-looking by necessity. Their job isn't to defend narratives. It's to allocate capital where the next imbalance might form. This is where retail often misreads the situation. They see reduced enthusiasm as lack of conviction. Institutions see it as discipline, and the gap between those interpretations is where opportunity and risk diverge. This doesn't mean silver becomes irrelevant. It means silver becomes competitive. One option among several, rather than the default choice, and when that shift happens, price behavior changes even if long-term fundamentals remain intact. The market stops rewarding loyalty, it starts rewarding selectivity. That's the environment Wall Street is preparing for now. One where returns come not from chasing momentum, but from choosing exposure carefully. Where being early matters more than being loud. And once that environment takes hold, the crowd rarely notices at first. They notice later, when performance gaps begin to widen and yesterday's certainty starts to feel heavier. Which brings us to the final question. What does all of this mean for how you should think about 2026? Not as a prediction, but as a framework. This is where everything comes together, and where most investors rush to the wrong conclusion. A setup like this isn't a signal to panic. It isn't a call to abandon silver or to suddenly chase whatever looks neglected. It's a reminder of how markets actually transition, slowly at first, quietly, without headlines or urgency, until one day the environment feels different, and only then does the narrative catch up. The mistake people make at moments like this is emotional compression. They try to turn a shift in risk reward into a yes or no decision, in or out, bullish or bearish, right or wrong. But markets don't work in absolutes. They evolve through phases. What matters now isn't predicting where silver trades next week or next month. It's understanding that the conditions which once made silver the clearest, cleanest expression of the metal's thesis are no longer as one-sided as they were. That doesn't erase the long-term case, it complicates it. Crowded trades don't usually end with explosions. They end with exhaustion. Momentum fades, rallies stop extending, volatility rises without progress, and the trade begins to demand patience instead of conviction. That's when investors who expected continuation start to feel pressure, not because price collapses, but because time stops rewarding them. This is why institutions focus on frameworks instead of forecasts. They ask different questions. Where is positioning heaviest? Where are expectations highest? Where does disappointment have the most room to form? Those questions matter more than any single price target. Silver may still have upside ahead. It may also spend long stretches going nowhere. Both outcomes can exist without invalidating what just happened. The danger comes from assuming that yesterday's conditions guarantee tomorrow's results. And that assumption is what Wall Street is quietly stepping away from right now. If you take anything from this analysis, let it be this. Markets don't punish optimism. They punish complacency. They punish the belief that a trade no longer requires monitoring because it already worked. 2026 isn't about repeating 2025. It's about navigating what comes after success, about recognizing when a trade shifts from opportunity to obligation, and about staying flexible when consensus becomes comfortable. You don't need to act today. You don't need to agree with this view. You only need to be aware that the setup has changed, and that ignoring change is far riskier than acknowledging it. The story of silver isn't over, but the easy chapter may be. What comes next will favor those who stay observant, patient, and willing to question what feels obvious. Because in markets, the biggest mistakes rarely come from being wrong. They come from being late. Stay curious, stay skeptical, and above all, stay ahead of the crowd.